In quite literally the span of 48 hours, Silicon Valley Bank just made history with the second largest banking collapse in US history. While, this is still a developing news story and we'll likely see the ripple effects of this over the next several days, weeks, and months. In this video, I'm going to try to break down how something like this could sort of just come up out of nowhere and, what this means for startups as well as the broader tech industry. I'll also do this while trying to minimize the amount of financial jargon I use. Quick caveats before we dive in. I've worked in software engineering in the Silicon Valley for my entire career, but I'm not a financial expert, I'm not an investment advisor, nor am I a venture capitalist. What follows are my personal opinions on what all is happening, and with all that aside, let's dive in. I'll start with a brief background of Silicon Valley Bank and the events that have just transpired. Silicon Valley Bank, or SVB for short, is essentially a bank for tech startups. It was founded 40 years ago in 1983 and was the number one choice for where startups put their money, similar to JP Morgan Chase for the general public. 2 days ago, on Wednesday, March 8th, SVB announced that it was trying to raise $2.25 billion. With that announcement, they also disclosed that they had sold off $21 billion in investments, had borrowed an additional $15 billion, and were selling off some stock, all in efforts to raise more cash. Startups who had their money in SVB then started, taking their money out of their bank accounts, and other startups would hear that these startups were doing that, and they would do the same thing, and it became this vicious cycle where all the startups sort of all at the same time started taking their money out of Silicon Valley Bank. Today, which is Friday, March 10th, federal regulators seized control of SVB, shut it down, and have taken control of their deposits. And with that, SVB, a 40-year veteran of the tech industry, is officially dead. If you're thinking that was really fast, yeah, that was really fast. This, 2-day meltdown is unprecedented. Let's now get into what set all of this into motion. First off, how do banks generally work? Usually what happens is people who have money take their money and they give it to the bank, so it's not just sitting under a mattress somewhere. The bank then takes that money and gives it out as loans to people who need money, let's say for a car or a mortgage on a house. These people then, pay off that loan on some sort of general cadence, let's say monthly, and they also pay insurance on that loan, which is how the bank ends up making money. There's a lot of nuances to all this, but essentially there's this constant ebb and flow of money where money comes in from people depositing money into the bank and money goes out in the form of loans to people who need money. SVB didn't quite follow this model because that model didn't work for its customers. Like we said before, most of SVB's customers were tech startups. These tech startups had tons of money and they would deposit this money with SVB. However, these startups don't need loans because they already have all the money they need from investors. I'm oversimplifying a little bit here, but roughly there isn't that same ebb and flow that was there with traditional banks. In this case, we have money coming in, but not money going out. So if you're SVB, what do you do? At the end of the day, you're a business, you need to make money, so keeping this money in a stockpile somewhere is a good recipe to make sure you quickly go out of business. So you turn to safe ways to handle this money, for example by making long-term investments in bonds. The traditional banking setup has risk because they're giving money to people and expecting those people to pay them back along with interest over time. These banks de-risk these sorts of money loan transactions by validating that the customer has a good credit score and has a job and thus would likely be able to pay back the money over time. For the SVB setup, the risk is that you're locked into all these long-term bonds, and if interest rates go up, the value of your bond investments goes down. Now, this isn't a huge deal if you don't need a ton of capital, and you likely wouldn't need a whole ton of capital as a bank unless all of your customers, for example, decide to withdraw all of their money at once and you need to have money to give to them. You might start to see where this is going. Interest rates are high now, and investors aren't handing out money anymore to startups as if it's, candy. So now, instead of getting cash through sort of the more typical channels of fundraising, like IPOs, acquisitions, VC fundraising events, startups are now getting cash by, turning to their own cash so they can pay, their expenses and make sure they pay their employees that are on payroll, etc. Now, the tech industry has been sort of on shaky ground for several months now, even approaching a year, and so far SVB had been able to, kind of sort of weather this storm. That all changed Wednesday, and unfortunately, it seems like this came down to the court of public opinion. That is, SVB fell prey to mass panic, and it's this panic that eventually ended up dooming the bank. So that news of SVB facing money problems came out 2 days ago on Wednesday, right? Investors see this and they tell their startups that they've invested in, hey, SVB isn't doing so hot. You should take your money out before things get really bad. Other investors and other startups see and hear the same things, and so they start taking their money out too, and they start saying the same thing of, hey, you all should take your money out as well. In turn, SVB sells more and more of its bonds in order to pay people back, but in doing so, it's also taking all of these sales at a loss. They could, probably keep this up for some number of customers, but if all of your customers are in tech and they're all hearing the same advice and they all start withdrawing their money at the same time, it doesn't really spell good things. And, we saw what happened. As we said before, SVB, Silicon Valley Bank, is no more. The wild thing to me is that Silicon Valley Bank has been around for 40 years. It, until today, was the 16th largest bank in the US. It's not like they were novices in this space by any means. I saw some quote somewhere where the CEO of Silicon Valley Bank, Greg Becker, had a 10-minute call with his clients, I think yesterday, Thursday morning. And in that call, he made a plea for the customers to support SVB the same way SVB had supported its customers for, the past 40 years. If they'd done that, if, people hadn't gotten into this sort of mass panic, probably pretty likely that the bank would still be around today. Now, the tech industry, which has already sort of been reeling the past several months, gets hit with a new blow. So what happens now? It kind of depends on whether the people who had their money in SVB end up losing their money, or if they do lose money, how much they end up losing. I might be taking a stance that's too optimistic here, and obviously I can't guarantee anything, but I think the damage here will mostly be isolated to SVB, and its customers won't lose much, if any, money. And why is that? Why do I think this? Because it's bad for everyone. Let's run through the scenario where people did end up losing money. Everyone at that point would then take their money and move it to sort of the strong, stalwart, historical institutions. So Citigroup, JP Morgan Chase, Bank of America, and so on. All the smaller banks, like SVB, would die, and there's a lot of these smaller banks. This is, obviously terrible for those banks. It's terrible for the economy, and, the federal money arms of the US don't want that to happen because it would create economic instability. What likely happens at this point is that some bank tries to go out and buy the remains of SVB, and the federal agencies like the FDIC will stipulate that that bank then has to make sure they pay back all of SVB's former customers, and if they don't do that, the deal won't go through. Of course, again, I could be wrong here, but I just don't see a case where the country would want any more damage to happen here. In a way, all of these government agencies kind of exist for this sort of scenario. They exist to help the country weather the storm and help keep the economy running. As a bit of a side note, this also means keeping the tech industry running, as best as they can, although the environmental factors that led to all of this happening are unfortunately still present for the tech industry. That's all for now. If you enjoyed this video and are feeling generous, feel free to give it a like. If you're interested in more videos about tech and the tech industry, that's what I do here, so feel free to follow the channel. Have a good weekend, everyone, and hopefully the coming days bring better news as this situation continues to unfold. See y'all later.